Prime, you're joining us on this special conversation with the management at Five Star Business Finance Limited, which is coming out with its initial public offering next week. The issue opens on the 9th of November and will stay open till the 11th. The company is looking for an offer for sale of about 1,960 crore, where its existing shareholders will look to sell those shares in the market. I'm joined by Mr. Lakshmipathy Deendayalan, the Managing Director of the company, as well as Mr. Srikanth Gopalakrishnan, the Chief Financial Officer. Gentlemen, welcome to this conversation, and thank you so much for taking time out to talk to us. Let me first come to the issue itself, the offer for sale of about 1,960 crore. Your major investors include SCI Investment, Matrix Partners, Norwest, as well as TPG Asia. Just curious to understand why these investors are looking to dilute their shareholding, why you do not need any kind of fresh equity when you're looking at an IPO.
Yeah, thank you for having us in this interview on the channel. See, first of all, there is no selling happening from promoter. I'm not selling any of my shares. I don't have any pledge of my shares on. So this is an offer for sale, and we don't intend to even raise primary because we are well capitalized. If you see our balance sheet, our capital adequacy is above 70%. So the only option left over is to bring the existing shareholders to sell. So I think that's the background. When we requested our existing long-standing shareholders, they have accepted to sell some portion of their ownership. So 4 existing shareholders are selling. One is TPG, Sequoia, Norwest, and Matrix. They were there in the company for last 5 to 7 years. So we have requested them. They have taken the request. So they have put down some ownership on the table to make this IPO happen. Because we also need more than 10% from a regulatory aspect to come for our IPO. So that's where we brought in the existing shareholders to sell and to make this IPO happen. So the IPO size is close to 1,960 crores, which is roughly around 13.5% of our complete shareholding.
Sure. Sir, what is the price band that we're looking at here?
So we are doing at a price band of 451 on the lower side and 471 being the cap price.
Okay, 451 to 471. Just curious to understand. So I was speaking with some of the people who deal in the unlisted market, and there seems to be a discount on the unlisted pricing. I'm just curious to understand why you chose this price band and not maybe a slightly higher one.
So I think it's a good news when we heard that there's a discount from the unlisted grey market, because that's where we intend to do it, because that's where the investors who are participating in the IPO will make money on the day one. So we want to keep a good amount of money on the table for the public shareholders who are going to participate in lakhs. So that's the intent where we brought down our price to the current level. That also there's also a good discount with our competitors who are there who are in the listing space. So it makes more attractive for people to participate in Five Star.
Mr. Pradeep, in your among your borrower base, you count small business owners as well as self-employed people who are your borrowers, who are majority of your borrowers. I'm just curious to understand, now that the economy is coming out of the effects of COVID-19, what does the on-ground situation look like for you?
As you speak today, I think people, the cash flow is far better than what it was during the COVID-1 and COVID-2. But there is some still struggle happening in the families of our customers. I can't deny that. But what is safeguarding our EMIs, monthly EMIs during this crunchy period is 2 things I can say. One is we have lent to our service customers who cater the day in, day out needs of a common man. Right. So if a common man has to thrive his daily life, he has to come to the shopkeeper, or he has to get the help from the self-employed. Right. That's point number 1, which is helping Five Star, customers to generate a decent cash. That in turn brings back to Five Star as a EMI payment. Second, what differentiates us is that we are fully collateral lender. All our loans are fully collateralized, and the collateral is a hard collateral where the family members live in. So we take the self residential property where the family members of customers live in. So even during the difficult times in last 20 years, what I've seen is they tend to pay the EMIs well to the secured lender rather than the unsecured lender. So one is the service sector whom we have lent, and the other is the collateral-based lending what we have adopted for last 20 years has helped Five-Star to navigate from even during the difficult times. I can show you with the data, our worst asset quality was 1.68%, which is 90 plus DPDs, which is one of the lowest in the lending space today, what you speak. But having said that, direct answer to your question, yes, there is still some COVID impact is left in the families of a customer, but slowly, strongly, they are recovering back.
Okay, fair enough. You talked about the 90 plus DPD at 1.68 being the worst number that you had seen on your portfolio, which is great because it's in line with some of the best NBFCs in the country. But trying to understand the norm changes that the Reserve Bank of India has brought in for non-bank lenders, where day-end marking of NPAs is required. You're also not allowed to upgrade the account unless a certain payment benchmark is met. Curious to understand, does that have any kind of impact on your portfolio?
It was having an impact while it was introduced in November last year, right? We went back to RBI and we requested that we lend to a retail segment where they have to earn and pay. So the due date is now not in their mind. It's only the due month that is there in the mind. Thankfully, RBI accepted our request and pushed the circular date towards October 1st.
Yeah.
What we did in last 9 months is we went back to our customers saying that there is a due date which is very important to maintain your credit scoring going forward. So anyhow you're going to pay the EMI within the month, better pay it in the due date. I can give you as a data point what this has happened in last 9 months is the last month what we ended October month, close to 95-96% of the customers were able to pay on the due date. Only close to 5 to 4% of the customers they slipped the due date, but they have managed to pay within the due month. So as a guidance I can give you, that will have a very small impact in Five-Star. As I said, a 90 plus during the June month was close to 1.10%. And when you apply this new RBI norms, the difference will be 0.75 to 1%. So in the numbers term, if the 90 plus, actual 90 plus of Five-Star is at 1%, this RBI new norms will take our NPA tag towards 2%. That's the max.
Okay, fair. Even at 2%, just trying to understand the situation on the portfolio. You talked about the fact that you focus on secured lending, and that's primarily why your portfolios remain in good stead. But unsecured is where a lot of the non-banking space is moving toward, especially targeting the customer base that you service. Because urban areas and larger borrowers, or better rated borrowers, are all pretty much saturated. So people are moving to the smaller borrower base. Does that feature in your future plans? Do you think that unsecured is a business that you want to enter at some point in time aggressively?
No, I don't think so, because when 20 years back, when I entered NBFC sector, my background was I'm a computer science engineer. So I joined lending in 2002 when I joined Five-Star. Very clearly on the day one, when I wanted to enter into this niche segment, lending to the small business lenders, I wanted to get into secured loans. My intent was not getting into the unsecured loans because these cash flows are vulnerable. For a period of 7 years, today our loan tenure extends between 5 years to 7 years. During this 5 to 7 years, I can clearly say the vulnerability will be higher, at least 10 to 12 months in this period of time. If you want to protect your EMI to be paid within the month, it should be backed on a strong collateral. I think that's our concept. But having said that, we have given a study report done by CRISIL, which is shown in our RHP, which talks about the service group of customers, and those who can afford to give a collateral is close to 22 trillion market opportunity in our country. So if the opportunity is so big and so large, why should we enter into unsecured? And definitely we will not get into unsecured lending at a ticket size of 3 to 5 lakhs at a tenure of 5 to 7 years. It doesn't make sense for us.
Got it. Okay, let me come to some of the risk factors that you have detailed in the ISP. And then after that, I want to touch upon a little bit about the future of the segment that you're in. As far as the risk factors are mentioned in a portfolio, you talk about the fact that the RBI has made certain observations in its assessment of the portfolio. If you can just tell us a little bit about what the RBI has noted and what has actually been done on the ground to sort of fix that.
See, so, we have had about 3 to 4 inspections now from RBI, right from 2018 financial year onwards. So broadly, if you look at, and these have been detailed in the risk factors as well. So a lot of these observations, the first thing we want to clarify is there has been no divergence in any of the numbers that we have put out, which will be what has been, brought out or computed by RBI. But having said that, inspectors who come with a lot of background, having seen multiple NBFCs and multiple banks, did advise us and tell us that you could follow certain best practices which are being followed by the other NBFCs in terms of credit underwriting, in terms of what are all the surrogates that you can take, given that these people don't have adequate documentary evidences and all that. So those are the things that you're actually finding as part of the inspection report. Certain of these points we have gone back to the RBI and said that practically the way you're looking at it may not work for our customer segment, which has been duly acknowledged by them. But as an institutions, we are always looking out for means to improve. So wherever we felt that the observations of RBI were to our benefit and will help us improve our processes, improve our underwriting, and improve our asset quality, we have actually gone ahead and taken it. So there have been no significant or material adverse remarks from RBI. A lot of it has been more qualitative, recommendatory, and which can be used by us to our benefit. We have taken it to our board and made changes to some of our policies like credit policy, collateral policy, and all that. And so that is what it is. So while yes, there have been observations, and definitely there will continue to be observations, we believe that we are operating in a reasonably efficient manner, that there will be no significantly adverse observations that will come from RBI.
See, definitely going forward also you will have observation and guidance. I think we have to take it in a right sense that RBI is advising an NBFC, which is a fast growing NBFC in a country. So we have to take that advice, and we have appropriately taken it. Let me make it very clear once again, there was no observations on the revenue side. There was no observation or divergence from an NPA side. I think let me make it more clear, the observation from a procedural and a policy side.
Right. So there was no financial impact of these observations. Essentially, that's what you're saying in the book. Sure. One of the other points was the concentration in 4 southern states: Tamil Nadu, Telangana, Karnataka, as well as Andhra. That's where about 38% of your business is coming from. As of June 30th of June. Yes, it's not that big a number to create a sort of a any kind of risk to the portfolio. But do you think that have potentially being present in majority presence within the South Indian states, does that have any kind of impact on the future growth of this business?
Let me first correct the number what you said.
Yeah.
On a monthly side, the business coming from South is close to 85 to 90%.
Right.
That's the number what we generate on a monthly.
Apologies for the 38% number. Yeah.
So and we are very happy to say we are a South-based lender. So where the market is more matured, where the underwriting is more clearer, and the practice of paying the EMI on time is more proven. So we come from that background. So we are happy to say that we are a South-based NBFC. That's point number one. Point number two, I think there are 4 big states which contribute the biggest GDP to our country is from Tamil Nadu, Andhra, Telangana, and Karnataka. So we are doing the business in the biggest states, where population also makes very attractive for us, because we strongly think population bring in good amount of trade. Good amount of trade in a region brings more people to come and settle, and more housing activity happens there. So your real estate also goes up. So from a win-win perspective, for us, cash flows come out from a good trade, and your collateral valuation also increase when there is an increase in real estate. So we want to be in a region or an area where you have a good trade happening back of good population, and real estate value stays there. So that's the background why we wanted to be more focused and more clearer on the South. Not only now, even after 3 years, we'll be a South dominant NBFC. As of June, close to 95% of our assets are South based, only around 5% are non-South. That will stay. Maybe it may increase to from 5% to 10% non-South, and still it will be dominant in South India. Just to give a metric, very close competitor of us, not to name here, they have close to 250 branches in Tamil Nadu. We have just 100 branches in Tamil Nadu. So we have 2.5x growth in branches in one state. Imagine the other states like Telangana, Andhra, and Karnataka. Huge opportunities available in South. So we want to be a South-based player for a reasonable time. But having said that, we want to have our seed branches or learning branches in non-South. So our presence is there in Maharashtra. Our good presence is there in Madhya Pradesh. Some presence in Uttar Pradesh and some presence in Chhattisgarh. We are learning the central part and the northern part of our country, so that in next 5 years, the big growth can come from the non-South area.
Okay. So that's what you're targeting for the next 5 years. Also, I wanted to ask you about the future course of the business. The NBFC segment has been vital in providing, credit to sections of society which probably can't access bank credit at this stage. But having said that, the Indian banking system is, sort of deepening its presence in areas where it was earlier not present. Do you foresee competition from banks which have a significantly lower cost of capital as they try to come into areas where you're present?
Absolutely not. One line answer is absolutely they can't come. They are not. I think they are not capable of underwriting the profile of customers whom we are underwriting successfully. See, let me spend some time on my operations, right?
Sure.
It is not a templated way in which we lend, right? And these customers, so-called any shopkeepers you name, or it comes in your mind, or any self-employed like plumber, electrician, which caters the daily need of a common man, they don't have a documentary proof to keep it on the show it to the bank side. For them, they can underwrite them. You have to spend some good amount of time at the ground level to check the cash flows, to check the character, to check the collateral. That is where Five-Star expertise come in, and we are doing it for last 20 years. We have touched close to more than 5 lakh customers, and we are underwritten more than 5 lakh customers in last 20 years. That's the institutional knowledge that we have got. I don't think any of the banks, leaving the government schemes, any of the banks are capable to get into the field level and do a 3 days check on the 3 C's, what I said, character, cash flow, and collateral. Looks for me, it's impossible for them. Let me talk about the NBFC, where you can expect some amount of competition coming from NBFC. Even from NBFC, let me put the lending spectrum into 2 ends. One end you have micro lenders, right? Microfinance lenders, and one end you have vehicle lenders. Like you can name anyone, right? Sure. What makes them not to enter into this segment is, I think from a microfinance perspective, there is no underwriting there. They go to a village, pick a guy, form a group, and lend to them. Whereas at Five-Star, you have to underwrite the cash flow, you have to underwrite the character, you have to underwrite the collateral, right? It takes 3 days for me, for 2 units, which is business and credit unit, to assess a single customer. It's not a play, right? It's not an easy game to play. So we feel microfinance lenders cannot enter into the segment because it's a pure play underwritten game. It's not a operational game. It's an underwriting game that you have to play here. Second is, a microfinance cannot lend at 3 to 5 lakhs. We are at 3 to 5 lakhs. That's the need of our customers. Third, we can lend at 7 years. Microfinance lender, they can't lend at 2 years. So these are the strong entry barriers for a microfinance companies to get into individual business loan lendings. So let me talk about the other end of the spectrum, where you have Cholas, Sundarams, Srirams, and small finance banks. They know they are good in assessment, but the average ticket size in which they are comfortable to do this assessment is around more than 10 lakhs, 8 lakhs plus, whereas our strong sweet spot is 3 to 5 lakhs. So that is why you see the competition intensity in this small business loan with a ticket size of 3 to 5 lakhs is it's still low. We feel it still will be low going forward, but we are not the gatekeepers. We pray more people have to come, but they have to deliver the same kind of quality and profitability what Five-Star has delivered and not spoiling the market for everyone.
So I just wanted to, take a minute or so to add or clarify a couple of points. See, when we talk about capability, please understand that we are not talking about their inability or lack of expertise to do some of these things. From a banking perspective, it's also regulatorily, there are certain requirements from their side. They cannot go for a non-paper based income. See, certain flexibilities that are available to an NBFC are probably not available to a bank. So they will not be able to do this from an expertise perspective, but there are regulatory inhibitions that may prevent them. And secondly, from an economic perspective, it doesn't make great economic sense for them. If it's got to be a bank branch, it'll have to be in a certain manner. It can't be, a no-frill branch like what we have. So from an economics perspective, a 3 to 5 lakh loan does not stack up for a branch or a large NBFC.
That's fair. And just to interject, the RBI has made room for banks to have these no frills, as you said, no frills branches, or even the DBUs that they're talking about, where they're going up to tier 6 towns now, according to the Reserve Bank's guidelines. The reason I brought that up is because the cost of entering that barrier is quite low for the banks. And even if they're not that successful, it's really a very small portion of the portfolio that gets impacted. So overall, the impact on their balance sheet is also limited. So this, considering that they are hungry for growth and avenues are limited, is this a place where they can enter?
They can enter. There's no way that we can't stop it. The point what we are want to make it more clearer is we are a single product entity. We don't know other than lending to small business entrepreneurs. Whereas a bank or a bigger NBFC, they have multiple products ranging somewhere between 6 to 20. So I don't know whether their concentration on each product that what we give will stack up. That's point number one. Point number two is clearly we have an edge of 20 years experience in this single product.
Right.
That makes Five-Star more capable of underwriting, quickly underwriting, and we have set up a collection model in such a way that we can reach a customer within 60 minutes when we see any trouble in the repayment. So these things a bank cannot put at the ground level is our strong hope.
So they will probably, piggyback on NBFCs, and RBI has come out with this co-lending.
Yeah.
So I think they will definitely. So RBI also clearly understands that it may be difficult for a bank to do some of these things. But exactly, RBI wants the capital benefit or the cost of funds benefit to go to the ultimate beneficiaries. Now, so what is the way to do it is probably, co-lending is the right approach, wherein, a bank can use the services of the NBFC. There is some level of risk sharing, but, there is a win-win for the bank, for the NBFC, as well as the borrower.
Are there any arrangements that you already have with banks in the co-lending space?
No, I think banks are approaching us. We have close to 50 relationships with bankers. But we are not showing any interest on co-lending because our capital adequacy is good.
We don't need the bank capital.
We are not need of capital as of now. So we are not thinking on co-lending as of now. As time emerges going forward, we may think on it.
See, we want to be a balance sheet business rather than a fee-based business.
Got it. Okay. Last question from my end. You've got a very big capital adequacy ratio. You're in a very sweet spot where there's limited competition, as pointed out. Others can't really enter or have not for their own business compulsions. In the next 5 or 10 years, I know you can't give too many forward-looking statements, but in the next 5 to 10 years, what to your mind is the potential here that we're targeting?
The potential is very clear. I have given 22 trillion market opportunity in our country. Just to break it in more clearer, India is a land of million shopkeepers and millions of self-employed, right? So the 22 trillion market opportunity is here to stay, and that will grow at 10-15% year on year. So we are just around 5,000 crores of AUM as of June, a little higher than 5,000 crores of AUM as of June 2022. So there's a long way for a 5-star to move into it. Two things I can share instead of not giving a forward-looking statement. One is we were growing at close to 90% year on year from 2015 to 2020. The COVID came in, we stopped our growth. We were growing at 15% year on year for last 2 years. Primarily, it's not because of lack of demand. We want to understand the impact of COVID to our customers' base and keep our collections intact. Once the asset quality gets into a task, it will take few years for NBFC to recover. So we don't want to we don't want to be in that position. So we put collection front in COVID 1 and COVID 2. So 90% pre-COVID, and you have a headroom of today where capital adequacy is 70%. The capital adequacy can be brought down to 35-40%. You have a big headroom for 5-star to grow its balance sheet without any further raise of capital. So opportunity is big. 5-star has shown that we are the fastest growing NBFC pre-COVID, and we have a very high headroom from a debt to equity perspective. So I think nothing stops us to go and reach this target, this 20 trillion market opportunity that's staring before us.
See, historically, we also operated around the debt to equity of about 3.5x. So from the current levels of about less than 1, for us to go to 3.5x with the market opportunity being available, and the support of 50 lenders today. As of June, we had a borrowing outstanding of 2,500 crores from 50 lenders, with the likes of some of the largest public sector banks on our debt table. So the ability to sort of increase the debt outstanding is also definitely there. We have explored multiple structures. So today, to borrow from multiple structures, the expertise is there in the company. So with the infrastructure, with the borrowings, ability to borrow more, and take the debt equity to to a much more manageable level, I think we are very clear that from both growth, quality, and profitability, definitely we will be really strong on all these 3 aspects in the years to come.
All right. Thank you so much, Nirupati and Mr. Srikanth, for joining us on this conversation. Pleasure talking to you, and all the best for your issue.
Pleasure from our side too. Thank you.
Thank you.